So now we have a whole new world in which we're going to create nationwide branch banks.
These are the super banks. These are Bank of America, this is Chase, Wells Fargo, a bunch of different really large banks. At the time, there were probably about 30 of them.
By 1990, 46 states allow out-of-state financial institutions to acquire banks in their state.
Okay, so now what happens? Someone's got to be in charge of deciding whether or not a merger can go forward. We can't just allow banks to merge, willy-nilly.
The banks have to apply. When they're acquiring other banks, they still have to apply to get government permission for those acquisitions. The Federal Reserve, a deeply politicized institution, is going to be the primary decision maker in deciding whether those banks get to acquire the banks they want to acquire.
At least some of the people in Congress see this CRA approval process as a means of leveraging banks to substantially loosen the flow of credit.
And so when barriers to mergers break down in the 90s, suddenly CRA became a tool where you could use this to hold up merger applications.
There are essentially 3 requirements to approve a bank merger. The first is the banks must be solvent. The second is the banks must not have undue market power. And the third is they must be good citizens of the communities that they serve. It does not take long to see that the first 2 requirements are set aside in favor of being a good citizen. And being a good citizen quickly becomes defined de facto as making what are called CRA loans.
So if you wanted to go to the Federal Reserve as a banker and pitch your case about why you were worthy to be given the permission to acquire other banks, there were going to be community activist groups from urban areas attending those hearings.
So one of the first groups to sort of show up is ACORN, the Association of Community Organizations for Reform Now.
And if they didn't like you, and if they could point to the fact that you hadn't done enough for them, that might sabotage your ability to engage in this merger.
All these organizations would come and say, we don't know how we're going to vote, but if you would do this, this, and this, we may look at that more favorably. And, you know how the game is played. It's not beat around the bush.
ACORN would sue the bank to stop the merger and say, basically, if you don't give us $10 million, we're going to take you to court, and this will last years.
And the Federal Reserve Board was kind of caught in the middle. Not saying that they were the ones who necessarily were pushing for this, but they are a deeply politicized institution.
They put it in writing. A merging bank agrees to channel funds through a community activist group who then makes loans to its constituents. In return, the group agrees to testify in favor of the merger at the Federal Reserve hearing.
This wasn't just an implicit partnership. This was an explicit partnership. And the partnership involved trillions of dollars of loan commitments by merging banks to urban activist groups.
It is something of a circus. In fact, merging banks will often bus in their own activists to testify against activists who are opposed to the merger because those activists have not been cut in on the deal.
Yes, trillions of dollars. From 1992 to 2007, more than $2 trillion of commitments. And almost $1 trillion of those were made explicitly as quid pro quos as part of merger arrangements.
Now, even for a rapidly growing super bank, $1 trillion in non-conforming loans is a large chunk of exposure. These banks want to merge, but this is getting ridiculous.
Banks are not in the business of making loans to people with low incomes and weak credit scores. They will only do so much of this kind of lending.
The only way that banks will agree to this deal is if they can spread or defer the risk. So, community groups start looking around. Who'd be willing, as in crazy enough, to underwrite a couple $1 trillion worth of shaky loans?
And they said, well, let's try to fix this by forcing Freddie and Fannie to get into the subprime lending business, and we're going to subsidize low-income people. The problem with that is that didn't work economically because the low-income people couldn't pay the loans back and shouldn't have been buying houses in the first place.
In 1991, Senator Alan Dixon of Illinois, chairman of the Senate Banking Committee, invites representatives of Fannie Mae and Freddie Mac to a hearing where they are confronted by activist groups.
And basically, the head of ACORN says that Fannie and Freddie are guilty of discriminating on the basis of income, and by extension, they may be racially discriminatory.
So let's start accusing the GSEs of redlining, of really making credit unavailable to certain populations. And let's force them to open up the credit box and provide credit to more people.
The heads of Fannie and Freddie realize they have been outmaneuvered, and they're going to get pushed to buy these loans.
In 1992, Congress passes the GSE Act, which requires Fannie Mae and Freddie Mac to acquire, from outside sources, mortgages originating in targeted urban areas and low-income borrowers. The GSEs get the right to back their loans with less capital than commercial banks. For every $100 in loans, they need hold only $2.50 in equity. Now the question arises, why would anyone buy risky loans backed by Fannie and Freddie when there's very little capital behind them? Maybe because they have the implicit backing of the US Treasury, which of course gets its money from you. The dot-com bubble and tech stock crash of 2000 burns a lot of investors and sours people on the stock market.
So now people have to figure out new places to invest. So one of the things they start thinking about is, well, the real estate market has been looking pretty good. We think we can invest pretty well.
Housing prices were going up substantially. People didn't really understand why, but what they knew is that if you could get into this business and ride the wave, you were going to make quite a lot of money.
A new 1997 tax policy makes profits from home sales under $500,000 tax-free. That, combined with low interest rates, the Fed's reaction to the tech bubble, makes the housing market look even brighter.
You could read articles in the lifestyle sections of newspapers saying, if you don't have enough income, don't worry, you can afford to buy this house. You can even take out a loan and remodel the house after you've purchased it. It is safe to say that everybody knew that anybody could get a mortgage.
By the time you get into the 90s, big commercial banks are now seeing real estate lending as an area for growth. They're essentially becoming the primary source of credit for housing. And there's, when they make you a loan, they're selling that loan to the US government. They're getting a government guarantee for 70, 80% of the volume at that point.
Traditionally, Fannie Mae and Freddie Mac hold and securitize prime mortgages, loans to people with good credit who can put 20% down. But by the end of the decade, 3% down gets you a mortgage. As borrowing requirements drop, making mortgage loans increasingly risky, the market for mortgage-backed securities actually heats up. And this is because the investment banks have figured out a way to spice up these securities by taking the risky loans and the not-so-risky loans and packaging them into one single security called collateralized debt obligation.
A bank will take my mortgage and several thousand other mortgages and pool them all together to try and diversify the risk of each of our individual mortgages, and then slice them and sell them off based upon the risk that an investor would be willing to take.
Here's how it works. You split a security into, let's say, 3 layers. Top layer, or tranche, is your solid or least risky loans, rated AAA. This is a pretty safe bet, but your return is not that great. This level here, the AA, is a little more risky, but you get higher rate of interest in return. Now, down here, you get your so-called Alt A and B securities. High risk, high reward.
And what came out was shiny and pretty and was sold to investors as AAA rated safe investments that just so happened to be making a little bit more interest than other AAA rated safe investments. It's a sausage made of sausages. Can you tell me if this new sausages are going to be delicious? And the answer is, well, how good were the old sausages? Like, we don't even know what animal they came from.
Now, it may sound insane that you do this with mortgage-bound securities and collateralized debt obligations, right? But here's the argument for why you can do this. Think about this. This is a security that is backed by a house. So if someone can't pay their mortgage, you get the house.
But even with an extremely receptive market for these loans, as affordable housing goals keep escalating, it gets harder and harder to find qualified borrowers.
The problem that the GSEs face and the banks face is this is a very large amount of money. Not everybody located in inner city areas of low income is creditworthy.
So in order to reach this arbitrary goal imposed on them by Congress, they had to do riskier and riskier and riskier loans.
They have to keep digging deeper and deeper for less and less creditworthy borrowers, which means they have to erode their underwriting standards, especially in mortgages.
This demand for borrowers encourages mortgage originators in the private sector to ease up on their requirements too. Maybe let the borrower use a credit card or an equity line to make a down payment.
So what you get is a lot of people coming into the mortgage business, new mortgage companies popping out of nowhere to take advantage of the scam.
A mortgage broker would say, what's your income? And it may say, well, it's $20,000 or something. Well, you don't make any more than that at any time. And, you know, it's too bad because if you had an income of $50,000, I could probably make you this mortgage. A lot of mortgages were being made on stated income, of all things.
Now, of course, let's not, you know, relieve of any guilt the people who were taking out the mortgages. Because people were going and buying homes they couldn't afford, taking out debt they couldn't afford, and what was their perspective? Yeah, worst case scenario, I'll foreclose. Who cares?
Banks like Countrywide would resubmit loans to Fannie Mae and Freddie Mac over and over again because they knew that the GSEs were only sampling a few percent of the loans that came in. If they actually caught a loan that was bad, then the guys at Countrywide would work on it a little bit and they would resubmit it. They knew if they submitted a loan enough times, the fish would get through.
Fannie and Freddie became the largest individual purchasers of the subprime and Alt-A mortgages that were securitized by the banks, that were backed by the worst loans, that those banks had sold to the private markets not using Fannie and Freddie.
Fannie Mae Freddie Mac knew they had a problem. Of course they knew they had a problem, but they're looking at happy members of Congress who are all delighted by the rise in home ownership and the illusory prosperity that we had during the period, and nobody wanted to say anything.
Once you got the securitization machine going, it became a game of hot potato, where I can originate something without regard to the credit quality, because it's going to end up in someone else's hands, maybe Fannie and Freddie's, okay, before I have to worry about it.
I don't understand why anybody would ever believe this, but if you do, then a mortgage will never be a problem, because even if the borrower gets hit by a truck, he or she loses his or her job, he or she can always sell the house at a profit and pay off the mortgage.
People really believed in housing prices going up. And I'll tell you what, it was a great marketing campaign by realtors across the country. And everybody had reason to believe it was true. If it were true, everyone wins.
So, should we still be worrying? Does this person have a good credit record? Does he or she have steady employment? Is he or she going to be putting 20% down?
Hey, put down any salary you want. Show us a library card, we'll give you a mortgage.
In 2004, when the mandates had been pushed so high that Fannie and Freddie abandoned the idea that they want loans to be documented. This creates an incentive, of course, for the American middle class to take out liar loans in order to buy the suburban dream house that they've always wanted.
It might have started off as a program for the poor, but because of the way it has to work, it becomes loan subsidization for everyone.
People shouldn't be forced to live in apartments. We should give them all homes. And bankers were saying, well, the Congress is telling us to do this. They've passed all these laws to make it easy to do.
When you tell somebody you get to enjoy the upside and you don't have any downside risk, you basically are telling people, take more risk. And of course they did.
Imagine a street of 100 houses. Each house is trading at $100,000. And then you have one transaction on the street where one of those houses trades at $200,000. The other 99 householders suddenly think they're an extra $100,000 richer.
That's the way people's minds were working. Very, very intelligent and financially adept people, as well as people who were not so sophisticated, because housing prices kept rising.
By the time we get to the 2000s, we have no money down. We have people going out and buying a house and having no equity in the house.
People are building second and third homes, and there's really no reason to be concerned about the value of homes going up.
Risk managers are telling Freddie Mac to not get into the business of buying up no-doc mortgages because it will take the country down the tubes. They end up, in fact, firing the risk managers.
By 2005, Fannie and Freddie's outstanding liabilities were almost as large as the total liabilities of the United States Treasury outstanding. They were absolutely enormous.
The politicians don't fully understand what they've done. Or maybe they do.
Everyone in Congress was behind this. Barney Frank, Chris Dodd, everybody in Congress was taking the money with both hands. They were having a party. Prosperity.